The capital setup that you choose in the business of private and hard money lending is really going to determine a lot about how your business looks and operates. We know all the options, and we are going to shortcut all of this for you right now.
Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Hadding. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here, Private Lenders Podcast. Thanks for checking out the show. Today we're talking capital. There are more sources of capital in this space of private and hard money lending than there ever have been in the past. Like there were very few. There were one or two, maybe three when we started back in 2007. Now there are at least 5 or 6, maybe 7. And we're going to break down all the pros and cons of the different ways that this capital can be used for your lending business.
Yeah. And I think it's important to kind of choose what works best for you in your situation, and maybe what potentially could work best for you now might be different. You might want to grow into a different capital arrangement in the future, but it's important to know which ones are, I think generally in most businesses, you try to kind of grab whatever types of capital you can, put it into your capital stack. I'll do a little bit of this, a little bit of that, a little bit of this, but they're all very different business models. The last thing you want to do is be like, oh, well, I'm going to create this big fund, but then I'm also going to do some direct placement. Then if those loans don't work, I'm going to do some, broker stuff to DSCR lenders. Like that is a logistical nightmare. To stay profitable and to stay functional, pick a model that you see yourself growing into and go all in with that. All right. So let's go through some pros and cons. Do you want to start with some of the institutional stuff, the raised capital stuff? Where do you want to start?
I'm going to start with broker being kind of the entry level of the world of private lending. And somebody came to mind when we were talking about this topic before we started filming. So brokering is exactly what it sounds like. You find loans in this kind of investment lending space. It could be a DSCR, it could be a fix and flip residential, it could be small balance commercial, whatever it might be. And you're brokering this to a lender, to an actual lender that controls their own capital, makes their own underwriting decisions. Nothing wrong with brokering. There really isn't. It's going to be like you're typically looking at making a point or two, which compared to controlling private capital, the whole thing with servicing fee and making money on the front, like it's pretty lean compared to that. But honestly, compared to some of the other institutional models that we're going to go through, it's not that much different to just broker in terms of revenue. It really isn't. One person jumped to mind. Like normally you would see brokering as like a, entry level in this world. Here's how you get started, learn what's going on, and then you figure out how to get your own capital and start lending. But oftentimes that's not the case. I know a guy around DC area, and he's about our age, been in the game for a long time. He does well. He places a lot of deals, resi and commercial stuff. And I was talking to him one time a little while back, and I was like, what? You never thought about going the lending route? You never thought about raising capital and doing the whole operation on your own? He's like, honestly, it's just not for me. Like, I don't want the responsibility. I don't want it to keep me awake at night. I don't want the risk. I'm good just being a sales and marketing guy and placing these deals, and then I'm done. I'm out of it. My risk is over. And there's something to be said for that. And knowing who you are, what you're good at, and what you're willing to take on.
Yeah. Obviously, you're limited on how big you can grow the thing. And that's okay, right? And it's just straight deal flow. It's just sales marketing. That's the whole thing. The whole business is sales and marketing, and the person that controls the money makes the rules. So there's obviously cons on there, but like Chris said, like if you're that personality type and hey, I just want to, I'm not looking at this as an investment vehicle like many hard money lenders and private lenders are. They think of this as obviously a business, but then also a investment vehicle. That's why we're in this business. And that's why we don't use institutional capital, because we make good rates of return on our own personal money and, our friends and family's capital.
All right, let's jump over to institutional correspondent. And let me define that for people who aren't familiar with these terms. So kind of moving up the ladder in terms of your level of control and responsibility of the capital, like starting with brokering and then moving on to institutional correspondent. This is if you fund loans and then you sell them to the institutions that are popular in the industry, like Rock Capital, maybe Torac. In the past, it was Pier Street, but they're not around anymore. Some people like that. Constructive Capital, I think, is another one, where basically you take their underwriting guidelines and you fund a loan for $250K, fix and flip, call it. And then within 30 days or so, you sell it off to them and assign it to them, and they give you the money back. So this is kind of the next step up from broker. It's not complete control of what's going on. You don't really control that capital. You're just kind of operating as a correspondent to their guidelines and pricing. It can be a good way to get some clients, to get some borrowers, to get your feet wet, to get moving in this business. One thing I would caution is that when you sign their agreements, the master loan purchase agreement, MLPA, you're signing a buyback clause so that if this loan defaults or if there's some kind of evidence of fraud or if something goes on, it can make you buy this loan back. So I would just go into that arrangement, that relationship, being very aware of that fact. You might be funding a loan of $750,000, and if it defaults, you might have to buy it back. Buyer beware, right? Like I said, it could be a decent way to get in the game. We don't love the model, but it's there. It's a big part of the business. So just be aware of what's going on.
Yeah, and the pros are, again, you're a sales and marketing company. If you're generating good business from a lot of the same borrowers, you can put out very competitive rates. You can put out very competitive LTVs. Chances are these are loans that you don't want to do yourself or you wouldn't do yourself. So if you're, if that's something that interests you, that's typically available, and you can scale and grow those things pretty big. Again, the cons, you don't make the rules. You follow their underwriting guidelines of what they're going to buy. And the biggest con, besides obviously buybacks, because that could be really detrimental, is when they decide they don't want to be in this asset class anymore, they decide that they don't want to buy your paper anymore. Well, you might be, SOL and not be able not be doing deals anymore, right? You might go from being a hero to zero very, very quickly just because they don't want to do deals, or they close shop, or they commit to buy something from you that you underwrote, and they decide, well, you know what? I don't want 80 LTV deals anymore. I want 75 LTV deals. And then you have to go back to the borrower and save face. So keep that in mind.
Yeah, I mean, there are a lot of smaller lending shops that are in business just because of this institutional correspondent relationship. Without that presence, that type of institutional capital being in our space, these smaller lending companies wouldn't be in this business. They weren't going to raise capital. They weren't going to do the whole thing. All right, so moving on to one other aspect of the banking and institutional side of capital, I would throw in the credit line model. This has existed for a long time in different capacities over the years, and it kind of comes and goes with the market. But when the market's good, there's definitely bank money in our space, and some lenders do really well with this. Like, they fund their loans and then they can sell it to their credit line. They're usually pretty cheap, right? You're talking about single digit rate of return for sure. Prime rate as of this recording is around 7. So maybe you're looking at, like, depending, maybe 6 or 7 or 8%, which is good. Like, that is a good cost of capital, especially when you're lending out at double digits. You're lending out 11, 12, 13. Again, something to be aware of whenever it comes to bank money, institutional money that you don't control, is that it can disappear when it wants to, regardless of what your loan performance is or what your company looks like or your underwriting is. That could disappear. And there are some horror stories from the past, from back in the day, where lending companies got a call from their bank, or maybe two banks, that talked to each other and said, look, because of what's going on with the economy or interest rates or our regulators, we have to pull your line. This $10 or $20 million that you have outstanding on this line is now due today, or end of the month, or end of next month. Something that just does not work. So it ends up in lending companies being Chapter 11. But up until then, they probably have a pretty good freaking run, and a profitable one at that. So again, something to be aware of. Know what you're getting involved in.
Yeah. And I mean, I think the responsible lenders that go in this direction don't fully lever some of this stuff up. They have wiggle room where if notes got called, they could buy them out with their own cash. If their line got called, they'd have backup plans to figure out ways to, you know, bring the bank current. But again, pros and cons of
Roll gun for sure.
the pros and cons of all the capital. And I think a lot of folks that have the wherewithal to go down the banking route like to start with that, just because they believe that it's just easier. They don't have to go raise capital. They'll have to create a fund. Hey, I can just get my banker to put up capital for some of these things. And I will tell you, not that we have experience with this, but other lenders in our group do have experience with this, and it is not it's not all that exciting. They've run into a lot of problems. They wish they could figure out ways after they get very large to not put all their eggs in that one basket. They lose a lot of control on some things, and it puts them into a frustrating situation because they don't control the capital, and the bank's making the rules. And listen, since we've been in business, the bank that we started with has been sold or merged multiple times. And guess what happens every time that merges or gets sold? Different people are in place. They have a different appetite for things. They want to do this. They want to do that. So buyer beware.
All right. Now we are transitioning from the bank and institutional side of capital over to private capital that you control, that we control, where we live and people in our mastermind group. Real quick, if you're interested in working directly with us, if you're watching this on video, just click below, schedule a time to talk to our team, learn more about working directly with us with consulting or the live events we have coming up. If you're listening to this, not watching it, then just go to hardmoneymastermind.com, click on live events, schedule a time to talk to our team. Okay, so private capital. And now we're talking about, there are a number of people in the mastermind who are just in the game to lend their own money. This is talking about other people's money, high net worth individuals that you've raised, and a few different ways that can be structured. First of all, we like this side of the capital world a lot more. You have a lot more control, flexibility. You call the shots in how your business operates, right? And you can hedge your bets by not putting too many eggs in one basket, meaning you're not getting all of your capital from one or two or three sources. Because if you do, then it can be just as risky as the institutional stuff. Like, say you only sell your loans to Rock, that's your only source of capital, or you have one big credit line from Wells Fargo, or you have one high net worth individual that's funding all of your stuff. They have all the control over your business. That's not a good, sustainable business model that you can be with for a long time. But if you have, either a co-lending operation or a fund, call it, and you have 25 high net worth people that are investing along with you, think about that level of control. Any one or two or even three or whatever the number might be of those high net worth individuals could back out. It doesn't happen often. It really doesn't. If you're doing good loans and servicing them properly, it doesn't happen often. But if they wanted to, or somebody passes away, whatever the circumstance might be, they can take their money and go elsewhere, and your business will be absolutely fine because you have another 22, 23 sources of capital besides that one or two or three individuals that just pulled out.
Yeah, we always kind of had this set up in our business that not one capital source. When I say capital source, like private capital source, private investor, we raise money from had more than, whatever, 10, 15, maybe as high as 20% of our entire portfolio, because everything comes to an end at some point. Everything comes to the end, right? Like, God forbid one of those investors dies and then their family doesn't want to continue to reinvest. Maybe a bad deal happens and they don't want to do deals, or maybe, they go and need to buy a business and they need to take out money and deploy it. You don't know what the situation is going to be, right? Things happened, over 20 years, time period, things happen. Most of the time, capital investors are putting more capital into your fund or into your private placement deals because you're showing them a good performance, giving them a good rate of return, and they continue to grow, tell their friends and family, invest more money with themselves personally, and do with self-directed IRAs. But times come where they might take money out of deals. And, if you wake up one day and all of a sudden, you have a capital source or capital investor that's like, hey, I need $2 million back, or I need this or that. It puts you in a sting. And uh, we know too many lenders that have set up the wrong capital. They just set up the wrong capital from the beginning, and they grew into it and they got comfortable with it, and it turned into a nightmare. And this isn't just institutional type capital. We know a lender that has $30+ million deployed with some capital investors that doesn't like working with, doesn't really like being involved in, and they control him and her. Like they get controlled because they raise the wrong capital and they have different expectations with different people. They lose control over this or they have that. So it's something serious that you want to take consideration when you're starting out. It's like any capital you can get, you get, right? Like that's a line. But from experience, be careful what you wish for on some of those things, because next thing you know, your capital sources are going to control your whole business. You have no control, and you got to start over from scratch in order to regain control.
I was thinking about this recently, that I'm really glad we got into the hard money lending business when we did in 2007, and we were forced to raise capital from private high net worth individuals because that was the only capital available. Yeah. And mind you, this is like the Great Recession, real estate and financial worlds had just crashed. Like credit lines were not available. Institutional money had not gotten into our space. It was only high net worth individual private capital raising. That was the only thing available. And I'm glad that we were forced to do that when we did, and that we've had these wonderful investor relationships with these people for so long now. And it's expanded out slowly, but like snowballed over time and combined in with our own capital as time went on. Because I worry, and I don't have to worry about this, but something that came to mind is that if we got in the business 10 years later, we might have gone that institutional correspondent route because it was too easy. When that money came out, like in 2015-ish, they were here in our office where we are right now from Wall Street, pitching us on, here's our money. It's probably cheaper than what you're using. Here's about what it would look like. Here's guidelines. And we, had PTSD flashbacks from the mortgage industry being like, we're not working on your underwriting matrix. I don't need your price add-on sheet. Like, we're not doing any of that. By that time, we were firmly established with our business and our private capital, and we were operating well. We were not about to deviate from that and start using their money and playing by their rules. But honestly, if we got in the game in 2017 instead of 2007, we might have fallen into that trap. Our business would not be the same if that had worked out that way, frankly.
Yeah, good point. It would have been, we did the heavy lifting early on, knowing what the model should look like and how we wanted to structure it and the control that we wanted, the relationships we wanted to build. And it takes time. I think a big fault to a lot of lenders these days is they get into this business and they want to grow this thing very, very quickly. And it ends up being reckless if it's not done the right way. Like, it takes time to grow a portfolio properly. Even if you are well capitalized, it takes time. Every day is a seesaw. Go find deals, go find money, go find deals, go find money, go find deals, go find money.
Yeah.
But at the same time, make sure it's the right capital. Make sure it's the right deal. Make sure it's the right capital. Make sure it's the right deal. Not every deal is alike. Not every capital source is alike. You got to constantly be grinding to do so. And I know that, I think a lot of, and this isn't to scare lenders, but I think that a lot of lenders, after they've been around for a few years, they see that the model isn't as sexy as what they originally thought. It's like, oh, wow, this is like a real business. This isn't like, oh, hey, I've got a few $1 million and I got a few friends that have a few $1 million. I can just go lend it out and make a good rate of return. Yeah, in theory, that's what it is. But if you want a responsible operation, you got to go find some real deals and some real capital and do it the right way, just to, keep this thing around for a long period of time. And, it's very doable, but again, it's got to be treated like any business and being taken serious like any business. And again, all of these capital models that we discussed, they all work. Start with you, figure out what your personality type is. What do you want out of this thing? Some of the most successful lenders we know in this space just lend their own money out, and they have a very clean, small, profitable operation, and they're comfortable, and that works for them well. There's also others that have a good operation and they're using bank lines and they're comfortable with that. Either they have bank lines securitized by these notes, or they have bank lines securitized by a rental portfolio that they had, and they've got good relationships with their bankers, and that works for them as well. So not any of these are better or worse. There's definitely pros and cons, and do what your risk tolerance allows you to do, and do what you're comfortable with.
So if you do find yourself on the side of the industry where we are with private capital, if you're looking to lend your own funds or that from high net worth individuals, we'd like to talk to you. Click below, like I said before, and schedule a time to talk to our team. If you're listening to this on audio, just go to hardmoneymastermind.com, click on live events, speak to our team. We hope to meet you in 2026. We'll see everyone here next time on the Private Lenders Podcast.
Thank you for joining us on this Private Lenders Podcast episode. Please note that opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, financial, and accounting professionals. If you enjoyed this episode of the Private Lenders Podcast, we would appreciate it if you could spread the word. Make sure to check out hardmoneymastermind.com, the #1 community for all private and hard money lenders.